Um, Hey everyone, thanks so much for joining us. As you're tuning in, please let us know where you are today. Just in the chat, we always love to see where everyone is tuning in from all over the world and all over ANZ. So we'll get started because we have quite a bit to get through. My name's Danny. I'm part of the Blackbird team. We're really excited to have Alex Mather here with us today. He is the founder and CEO of The Athletic. So it's a subscription-based sports website. So in less than 4 years, and I'm sorry if these numbers have probably gone up now. So Alex has signed on more than 600,000 paying subscribers to the platform, thereabouts. And he will be taking us through consumer subscriptions today and sharing some of his strategy on how he's built this subscriber base. So we're going to leave around 10 minutes at the end to get to all of your questions. Please put them in the Q&A function and I'll make sure we get to as many as we can. But I'm going to hand it straight over to Alex now because we have a bit to get through. Thanks everyone again, and sorry about the timing this morning, and so glad you could still all make it. Thanks.
All right, thanks Danny. I'm going to share my screen here. Hello everyone. You may hear, I'm in San Francisco, the foghorn in the back, or my son, who is about 18 months old, who wakes up from his nap in about 30 minutes. So we've got a little bit of a timer here. So let me pull up the presentation and you should see it, yeah? How's that look, Danny? It looks good. Great. So only 8 slides today. And so I'll go as deep as you want on any specific area as soon as I'm through the 8 slides. So who are we? My co-founder Adam and I founded The Athletic in 2016. We're headquartered in San Francisco. We have offices in New York, LA, Melbourne, and London. We have the largest newsroom in sports after 4 years. So my just in terms of a background, my co-founder Adam and I met at our previous company called Strava. If any of you are familiar with Strava, it's a health and fitness social network and subscription business. I was lucky enough to be a very early employee there and built the product and design teams there. Learned a ton about subscription businesses and thought, hey, what kind of subscription business could be interesting in 2016? I'm a sports fan from Philadelphia. And decided to give sports media a try. And so in the last 4 years, we have hired over 500 full-time journalists. I'll get to what they do and what they cover. Basically, we're like the New York Times for sports. And so we had a belief in 2016 that, and I don't think this is controversial, definitely not controversial in 2020, but that digital advertising wasn't going to support digital media. And with Google, Facebook, really taking up the lion's share of ad revenue, there was going to be obviously some pretty big changes happening in the media industry. And I think if we thought X was going to happen, 10X happened in terms of the effect on the market. The ad industry definitely cratered. And folks have been moving ever since to subscription, and we have been that way from day one. And so we produce about 200 stories a day now. And for context, that is a little bit more than the New York Times produces. Obviously, we cover sports. We're not necessarily like on the front lines of a wildfire in California or on the front lines of a war in Syria or something, but we do produce an incredible amount of content, and we charge for it all. And so we just hired actually our first international business person, and he was doing some research as he was looking into the market, and it turns out that we were the fastest to update your number, Danny. We now have over 1 million paid subscribers, crossed 1 million earlier this summer here. And we were the fastest media publisher to ever reach 1 million subscribers by 1 month. We beat the New York Times by 1 month. It took us 4 years and 7 months to do so. It took, for context, the Wall Street Journal here in the US about 10 years to reach its first million. So an incredible amount of focus for us has been just on subscription. And I'll touch on, we've raised a ton of money to do it. We started out in 2016, where we raised $120,000 from Y Combinator, and a few angel checks here and there. And off we went. And since then, we've raised $140 million or so, give or take 5 million or so. And our largest investor is actually Founders Fund. And I'll touch on that in a second. So what do we do? Well, we cover the world's largest sports. Just to get it out there, we are not in Australia yet. While we do have employees in Melbourne, they are technical employees. They are not covering Aussie rules or anything like that. We do have plans to cover some rugby and some Australian friendly sports like cricket. But most of our efforts have been on the leagues you see here: the Premier League in the UK, the NFL, Major League Baseball, NBA, and hockey here. We do cover boxing, golf, UFC, and motorsports. And so, like I said, we have 500 full-time people writing. My co-founder and I did not come from media, so we had no idea how to manage 500 journalists. We thought of that as an advantage. We could, start from scratch, figure out things as we go. Our methodology, just so folks understand, is we were born in 2016, and we looked at a lot of companies like Uber or DoorDash and said, what they're really good at is they figure out how to operate in a specific city, and then they go basically with that playbook and go city by city. And that was very much our approach. And so, while we started in Chicago in the United States, we hired, I think, five or so folks in Chicago. And then we went market by market, hiring the best people we could find anywhere. And so, putting stuff behind a paywall, incredibly challenging. So you need to hire the best people. And that's what we've done now across, I think, about 60 different local markets in the US and Canada. And then we have the largest sports newsroom in England, covering the world's largest sport, which is soccer. And so, it's been a crazy 4.5 years, and I'll touch on a little bit of the product. And then hopefully, actually I have some numbers here first. So the sports that we cover, there's 1 billion plus fans. Obviously, when you're building a subscription business, you're not like an advertising business. We're not trying to provide something of value to those 1 billion plus fans who follow, soccer, basketball, and American football. What we do is we look for the best fans within that billion. And so we don't know the percentage. I'll get to that in 1 second, but we basically went market by market, like I said, and hired great journalists. And with that, there was a little bit of a hack when we started, and this was super helpful for us, and we wouldn't be here without it, which was when you hire a journalist, they generally have a Twitter account, and that Twitter account has tens or hundreds of thousands of followers, maybe even over 1 million followers. And basically, when you hire that journalist, they start writing, they start posting the stories to their Twitter. Folks really support them, and you can build an audience that way. And that's been really effective for us. And if you see a business like Substack right now, very popular, folks are jumping from their media jobs elsewhere and joining Substack and using their Twitter audience to grow their Substack. And so that was very much our approach. We did it at scale with 500 folks. We have over 1 million subscribers, and we have actually launched, I think, about 150 podcasts along the way, covering major leagues, teams, and things like that. And definitely over 5 million. I think this month was, or the previous month, sorry, September, was over 9 million listeners. And so building this broad sort of media approach here. Now, if you think about our 1 million subscribers, our average price is about $63 a year. And so, $63 million in revenue. We've raised 140. We've got a long way to go. But one of the things that's really exciting for us, and definitely the biggest challenge of launching a subscription business and trying to get venture funding, at least in 2016, maybe less so now, was every investor said, that sounds like a really cool idea, but a subscription business is generally too small. It's just not venture scale. It's not big enough. You're not going to get enough subscribers. And while that may have been, sort of the prevailing thought in 2016, I think folks are starting to figure out that we don't actually know what the TAM is for subscription businesses. If you would have said that Netflix would have 200 million subscribers by 2020, most people would say you're crazy, right? No one would have guessed that they could get that many subscribers, except perhaps the folks within the walls of Netflix. New York Times 2 years ago, they said, our goal is 10 million subscribers by 2025. They will hit 10 million subscribers by 2021. And so even a company as old and as well regarded as the New York Times can't really gauge how big the market is for folks who want to pay for great things. I'm, like I said, in San Francisco. If anyone knows, right now we're going through a lot of smoke from wildfires in the area. I have a Peloton bike. I can't stop spending time on my Peloton bike. I love it. It's easy. I'm a new dad. How many people thought that folks would pay $3,000 for a bike and then $40 a month for a subscription to a glorified exercise bike? Well, I think the company is now $70+ a share, $20+ billion market cap, absolutely showing that people will pay for things they really value. And in the last couple months, actually, in the last couple of weeks, I apologize, the incoming CEO at the New York Times updated their guidance to something like 25-30 million subscribers. And so what you're seeing is, perhaps the first 25 years of the internet, everything was free, everything was digital. Everyone was kept hoping that digital ads would take them to where they were with print ads or TV ads, but that never happened. Facebook and Google really swallowed it up. And what you're seeing now is it's really hard to build a quality business, but if you do it, folks will absolutely pay. And so, we've been at the front line of this in publishing, and I think you're going to see this in a lot more industries. Charge people a premium for something great, and they'll absolutely pay it. And so what are we? Well, we're, what a modern media company should be. We're mostly a journalism company. But like I said, my background is product management and product design. We are a technology company as well. We have almost 100 engineers, designers, product managers, and such. And so we're trying to be sort of at the forefront of what it is to be a modern media company. And so, we are newsletters, breaking news, podcasts, Q&A with our authors. We're building our own, we joke, but we call it our own little Twitter competitor, where our team of 500 folks can write short form content. Because I'm actually sitting at my desk in my bedroom in the pandemic, and there's a magazine on my desk that I've been meaning to read for 7 months, and I just can't ever get to it. And so just because I pay for something doesn't mean the content has to be long form, right? You can pay for really high quality short form content. And so we've been really investing in our platform. We own our entire stack top to bottom, and that has enabled us to really learn very quickly what's working, what's not, what our subscribers want. And it seems small, but these kind of things over 5-10 years really differentiate us versus most folks in media who are, maybe they're outsourcing their tech, or maybe they're not even investing in it at all. Okay. And we are in the app stores, and it's always one of the things you do when you're in the app stores, you look at the companies around you. And that's really important to understand where you are. and in the UK and US, the companies around us are generally like really big, leagues like Major League Baseball or UFC, or their television networks, which is really cool. And so we've been able to build, a really great business in the App Store as well. And unfortunately, we do pay the 30% Apple tax. And our audience skews very male, which is somewhat to be expected with our vertical being sports. Our age group is 70% 18 to 44. And basically what we see there is, folks who are younger just are used to paying for stuff. I remember, not paying for music and stealing it. And then, when Spotify got good enough, I was like, you know what, it's just worth it. I don't have time to deal with, downloading crappy music. I'm just going to use Spotify. And Netflix and other products like that have really made folks accustomed to paying for stuff they want. And then final slide, just to give you a sense of the team. I mentioned most of this, but really continuing to build out the team, mostly in our content org, and focusing on things like soccer and future cricket. And then the final point is, to get here, we've raised a lot of money from a lot of different types of folks. And so you see Founders Fund, which is obviously, investing in companies like SpaceX and Boom Supersonic and some crazy Enduro, some crazy companies that are really at the forefront of technology, but also they have a vision of media that aligns with ours. And then you see, Y Combinator, and then folks like Laureen Pal-Jobs at the Emerson Collective, who's very invested in media being a sustainable business. So that's my prezo. I think I'm 3 minutes under. So I'm happy to answer specific questions as it relates to media, as it relates to subscription businesses, paid acquisition. I can go as nerdy or deep as you'd like.
Awesome. Thank you so much. So our first question here is, given the increasing value delivered through a more sports coverage over time, how does that impact thinking on pricing?
Yeah, you sound like one of my board members. Great question. So if any of you have Netflix, you know that Netflix seems way too cheap, right? But the goal is growth. And so it's one of these things that you balance. And we're always trying to balance growth rate with, sort of ARPU. And ARPU for us right now, we're happy in the $63 range, but we think, frankly, if we fast forward 5-10 years, we think somewhere around $100 feels like the right ARPU. If you look at a New York Times, its average, its MARPU, its monthly average revenue per user is something like 17 to 18. Ours is 5. Right. So there's a ton of room to grow for us, but we're mostly focused on growth right now. And one of the things that we see, especially with younger companies, is you have to really win folks over, right? Your brand is new. They want to get in there and try it, right? If you remember, Netflix even 5 years ago had so many free trials. Spotify, even this year, is doing $1. And if you, I don't know if Disney Plus is in Australia, but you can't miss it in the US because they're giving it away with everything. I think you buy a scoop of ice cream and you get 6 months of Disney Plus. So, it's really about getting folks in the door, building habits, and then really starting to leverage your price.
That was a great answer. Thank you. What was the pitch to writers to get them to come to The Athletic? How has that changed? How does your remuneration policy work?
So the pitch was something that, frankly, when we started the company, like I said, we don't really have a media background. It was so intimidating. But it turned out to be, one of the more natural aspects of the business. And, I'll make it very quickly, which is, we're here to do a few things well. Number one, we want you to do the best work of your career. Number two, we're going to give you all the data and resources to do that. And number three, you don't have to chase all the things you used to chase, which were clicks, press conferences, the 10th microphone in Steph Curry's face. We're asking you to do the opposite. If you're the 10th microphone in Steph Curry's face, then how are you going to provide something different, right? And basically, once we nailed our pitch, we actually pay better than most other places, and we give 100% of our employees equity in the company. So we treat them, closer to a Silicon Valley employee. They started to sell for us, and any startup that goes from like 0 to almost 600 people in 5 years, you have to scale hiring. And the way we scaled hiring is journalists started telling their other journalists, you have to work here. This is truly the best job on earth. And now in terms of how we pay them, like I said, it's mostly salary. In the beginning, we were doing bonuses based on how many subscribers they brought in. And then we had a couple folks bring in too many subscribers, and then lawyers got involved because they were making too much money, and we got scared. So we started to fix all that. But really, once someone figures out how to work with us in subscription, right? It's not like free media. It's not like you're chasing sort of the crazy headline that clickbaity kind of thing that sits on Facebook and torments the world. What we're trying to do is really write a check and cash it. And so someone has to retain really well, right? And so that means, they want to stick around. You have to really, really deliver in the story, not just the headline. Our focus is on long-term. Right? We talk about no shortcuts. We talk about really like a long-term relationship with our user, a long-term relationship with our athletes that we cover. We're not trying to burn them, right? Like we're not trying to say how bad they are or how great they are. It's really real sports fans. If, the casual sports fan goes up and down, real sports fans are a little smaller of a sine wave. That's how we've looked at it.
Awesome, thank you. What are your main customer acquisition channels? How has this evolved when you enter new geographies and countries?
Yeah, so the playbook has really been, sort of month 1 to 2, maybe the first quarter is really Twitter. So we'll hire a bunch of writers. They'll have this big Twitter audience. Those folks will come in. And that's been really great for us. It's embedded in the costs of hiring the writer. Performance marketing has been really effective for us. And so we do a ton of that now. About 30% of our subscribers come from performance marketing. We spend between $1 million to $2 million a month on that. And the way we do that is really fun. Luckily sports, very identifiable on social networks, so you can target pretty easily. And then we use geo, obviously. So if you're in California and a basketball fan, you either like the Warriors or Lakers, we can, kind of focus on that. And then we pummel you with stories. We're not advertising to you. We're just giving you stories. We're dripping you stories, some free, some paywalled. And then we offer you $1 off. And then if you hit our paywall, it's like if you looked at that one pair of shoes online and that pair of shoes follows you around the internet. Well, we sort of follow you around the internet with better and better deals, hopefully just winning you in. And that's been very effective for us. In the beginning, we generally did annual plans. And so someone would pay for a year up front. It might be 50% off, but that gets us all this cash up front, which means we can fuel more performance marketing. And then finally, recently, we've started to really branch out and do, for example, audio. So multi-pronged strategy there, which is we have our podcasts, which reach 5 to 10 million people monthly. Those are free, and then folks listen and hopefully subscribe. And then we're actually getting our people on the radio. So our reporter gets on the radio in Minnesota or Florida or something and talks about Jimmy Butler. We have so many folks in the UK right now on TV talking about the transfer window. And so that's been really effective for us to get our brand out there.
Oh, do you have any advice for companies that are currently on a free offering and they're wanting to transition to the paid subscription?
Really hard. This is really, really hard. I've mentored a few companies from Y Combinator going through this process. You have to really decide, right? It's like one of these things it can't be like like a half-assed diet, right? You really have to go in and say we are either going to like have a comprehensive revenue strategy or not, right? You can't like take one thing of the 10 things you do and charge for it and expect to make money. So you're better off going as far as possible. I can speak. They've been pretty public about this. My previous company, Strava, went through this. I was the head of product, and we built, a very, very big top of funnel by offering a really great free product, and then over time started to, really ramp up where the paywall is. And it's an art, not a science, but that recently they've gone really full paywall, and it's been unbelievably successful, right? And it's really like, when we started the company, we said, well, we can do some things for free and some paid. And then we were like, if we just make it all paid, then we're going to, like, number one, we're going to get more money because people have to pay. Number two, we're going to learn pretty quickly, or I should say a lot more quickly, what works and what doesn't for paid, for getting folks to take out their credit card. And that lesson, that actually like understanding what people will pay for, is the key. And so, like, my advice, I have no idea what company, product, whatever, is if you're going to do it, like, really do it, and put up as big a paywall as possible.
Thank you. How do you balance spend on brand building versus paid acquisition? And this is our second last question.
Yeah, it's a really, really, really good question. And one that I'm grappling with right now. The head of performance marketing and the head of brand marketing both report to me. And we're looking at 2021 and saying, okay, how do we think about this? And the one thing that I will say that really unites everyone is finding a way for you to value brand marketing. Now, it's not going to be the same as, you're not going to throw around accurate CAC for brand marketing, right? It's really difficult to do. But the one way that I've found successful is we look at Google organic searches, right? Branded search is the easiest way for us to evaluate brand marketing, because all else being equal, if folks are searching your brand, they're hearing about your brand, and no matter what you tell them to do in your brand marketing, they're just going to Google you. And so it's like, that's our indicator. And what we do see is there is a strong correlation between, or I should say a strong inverse correlation between, brand search and CAC. And so as brand search goes up, branded search goes up, CAC goes down. And so that's been really effective for us. And so, we are, probably 80% performance, 20% brand, and maybe 25% next year versus 75, something like that.
Awesome. Last question. How do you assess a new market? So you've mentioned Aussie sports, but Australia is quite a small market by comparison. So yeah, how do you kind of assess when you're going to move into a new one?
Yeah, so we're working on this right now. What my chief of staff actually just delivered me a 300 slide deck on the world. And so I've got some reviewing to do, but the vectors we look at is, like, obviously the size of a market. But while Australia may be small in terms of population, its propensity to pay is very high, right? There's like a clear signal that the folks in Australia pay for things. And so there is an avidity for local sports like Aussie Rules, or sports like Premier League or NBA, right? There's like we have a strong product for folks in Australia that perhaps is different than whatever Rupert Murdoch is pooping out today. And so, and then, speaking of Rupert, is, we have to look at who we compete with, right? Who are you actually competing with? Really get in there and understand. And then the final thing we look at is partners. Like, do we want to go it alone? Do we want to be The Athletic straight to consumers? Or do we want to go through Tegna? Is that in Australia? No, there's another one. We met with some telecom. I forget what it was called. But like, do we want to like partner with a a telecom to go to, to get to consumers faster. And so you look at all those things, and what's interesting is there is a bit of randomness to it, I will admit. Like one connection that someone has somewhere to get things going actually is one of the more effective ways. So like, oh, one of our colleagues knows a writer that's really good, so we can get that person right away, and then they can get the next 5 people. It's often as little as that can drive the difference between a Germany or an Australia.
Awesome. Love it. All right. Well, that's all the time we have. So thank you so much, Alex. That was really great. Just on behalf of Blackbird and everyone on the call today. So everyone hopefully can join us for our next session, which is Thinking Like Your Customer with Kirsty Trail. She'll be with us next Tuesday at 8 a.m. Eastern Standard Time. You can book through our community page or take a look on our socials for that. Then again, just a big thanks to Alex for joining us this morning and for all of his advice. Thanks, everyone. Bye.